Introduction to Financial Modeling. Definition. Financial modeling involves creating a summary of a company's expenses and earnings, typically in spreadsheet form, that can be used to calculate the impact of a future event or decision. Purpose: to help in decision-making process. Forecast future financial performance. Budgeting. Valuation. Components of financial model. Income statements. Detailed revenue, expenses and net income over a period of time. Balance sheet. Summarize the company's asset, liability, and shareholders' equity at a specific point in time. Cash flow statement. Shows the cash inflow and outflow from operating, investing and financing activities. Common types of financial modeling. Three-statement model. Integrates the income statement, balance sheet and cash flow statement into one dynamically linked model. Discounted cash flow, DCF. Projects future cash flow and discount then to the present value using company's cost of capital. Leveraged buyouts, LBO. Assess the potential returns from a leveraged acquisition by forecasting the target company's cash flow and debt repayment. Mergers and acquisitions, M&A. Evaluates the financial impact of combining two companies, including synergies and integration cost. Sensitive analysis. Tests model outcomes under different scenarios by changing key assumption. Application of financial modeling. Raising capital. Helps companies understand their funding needs and structure financing. Acquisitions. Analyzes the financial health and potential returns of target companies. Business growth. Plans for expansion by forecasting revenues, costs, and capital requirements. Budgeting and forecasting. Set financial goals and monitors the performance against budget. Valuation. Determines a company's worth for investment, sales, or merger purpose. Tools and software. Primary tool. Microsoft Excel is the most commonly used tool due to its flexibility and functionality. Reason. Excel allows for detailed and customized financial model with various functions and tools to analyze data. Who builds financial modeling? Professionals. Investment bankers. Equity researchers. Corporate developers. FP&A analysts. Roles. Each of these professionals use financial modeling for specific purposes such as investment analysis, financial planning, strategic decision-making. Steps for building a financial modeling. Defining purpose. What is the purpose of financial modeling? For stock investing, valuation, merger acquisition, financial analysis, financial planning. Historic data, at least 3 years input. Ratio and metrics. Calculate ratios metrics such as margins, growth rates, asset turnover, inventory changes. Assumptions. Build ratios metrics into the future by making assumption about margins, growth rates, etc. Forecast the 3 financial statements into the future using assumption. Valuation. Value the company using the discounted cash flow, DCF, analysis method. Analysis and insight. Sensitivity, scenarios, chart, graphs, dashboards. What makes a good financial modeling? A good financial model is simple enough that anyone can understand it, yet detailed enough to handle complex situations. General best practice for building models in Excel. Well structured with good layout. Easy to follow and understand. Drivers and assumptions clearly laid out. Simplicity over complexity. Accuracy. Focus on important issues. Visual outputs.